migration to regulation, and the minister was talking about the introduction of the framework. We started work around this in 2015, and back then, when you talk to large platforms and trading exchanges, etc., say regulation is coming, they all thought that we were completely crazy. And it was only sort of FATF in 2019 that sort of triggered some more global discussion. So what has actually happened in Gibraltar? I've been involved in lots of very interesting and different things from DM and others, but what's happening in Gibraltar, it's showing. So the Zappo group conducted their global migration of the VAS platform to Gibraltar and also obtained their credit institution banking license here. The Bullish and Block 1 platform who are going to be regulated in Gibraltar. Everyone knows about that, but few people know that they're actually regulated out here. Bitso is a huge, probably the largest trading platform in Latin America. I've worked with Bitso for years now. That's some public information, and obviously the support of the Ecuador project and the Cuvo application, etc. Few people know that that's being serviced from an exchange platform in Gibraltar. Huobi and the group who have all their operations based out of Gibraltar, and the charity, which was also set up here for the million BTC value contribution to UNICEF, is also here. The Almax guys, and you'll hear from Jenna later on, they're big numbers. I mean, these guys are just tracking Coinbase, but again, Almax Digital were super happy to have invited out here as well. And Zuba, the first platform to have been acquired, to have been licensed this year, and the acquisition by FTX, I mean, that's also super interesting when we talk about the concepts of migration to a regulation. The Amber Group out in Hong Kong, the Presto and the Quant guys out in Korea, the Holo chain, and beyond that, RSK, some of the underlying protocol layers have established operations out here as well, and Gnosis that a lot of you will know. So we're not sort of talking about this in theory, we're not sort of speculating about migration to regulation and proper regulation. By proper regulation, obviously, I mean bringing activity within the scope of prudential supervision, not a simple AML registration requirement. And beyond that, the services industry to support that. So Greengage, and you'll hear from Sean separately, but the fact that we have banks being set up here specifically to service a regulated industry is pretty significant. They can enter into those discussions with the authorities and have the support that's needed to do that is super material. And obviously the fund industry, we talk about security around that. I mean, we're ranked, I think, 3rd in the world at the moment in terms of the volume of those assets within the regulated fund industry. So how does this all happen, and what are the issues around it? Regulation is regulation. The FATF started in, it was 2019, defining the concept of a virtual asset service provider. And I'm only sending that out simply because, I mean, it's been interesting. Some countries legislated before 2019. They've been reacting. Are we capturing everything? And then there's a more complex question, which is the emergence of new applications of the technology, the emerging and developing DeFi universe in industry. What's happening? Is that a VASP? Isn't it a VASP? What interpretation of what element of the FATF definition are different countries interpreting to bring all of that activity within the scope of standard regulation? Or how are they managing the risks around not regulating those new emerging systems? And I've jotted out some sort of, this was a second 12-month FATF review. I mean, in reality, it's difficult for, I think it's 52 jurisdictions that have actually tried to comply. I mean, 15 of those haven't been able to comply just with the FATF initial definition. So when you start talking to some of those authorities about emergence and new platforms and new applications, some of them are struggling to do that. So again, we're talking about regulation, we're talking about migration, and we're talking about DeFi high level. Some of the issues are already starting. So is this regulated or not? And there are lots of issues around that. I mean, I've defined some of them. In the EU, the MiCA framework uses this term operation of a platform. What is the operation of a platform or can it be captured within a DeFi context? Concepts of control, concepts of facilitating activity. These are things that have to be considered, and it needs to be assessed and approached not from an output perspective. So we can't be sort of reacting to numbers and sizes at sea. And that's where some jurisdictions, I definitely put Gibraltar in that category, can aim to define and set new standards, exactly as we did within the DLT universe in 2017, 2018. But what are the issues? I've referred to the Dino issue. I mean, the Dino issue, I call it Dino, it's sort of decentralized in name only. There are lots of platforms and operators out there that seem to think by using the term decentralization or DeFi, they are suddenly outside of the scope of the purview of any law or regulation. That's not quite accurate. But again, there are issues with actually trying to bring that within the scope of any form of control. Again, the second 12-month review there talks about some of the commonly cited issues in just standard VASP regulation, so operating and regulating an exchange, lacking the experience, lacking the knowledge within the authorities to allow that to happen. But DeFi is growing, and some of those countries need to consider what exactly is happening and how to approach it. This is a Chainalysis index score, an adoption index score. And yes, fine, the USA is number one, but it's interesting to see some of the other countries there, Vietnam, Thailand, India, the Netherlands, Canada, Ukraine. I mean, there are countries there that people might not think are super advanced in terms of defining VASP regulation, but the reality is that the population is adopting the use of the technology in a decentralized context quite significantly. And what does that mean? Does it matter at all? Is it irrelevant? And I've talked about, I mentioned some of the risk mapping exercises that jurisdictions and authorities at the moment need to conduct. And you can kind of break these down. I've put a few headings in there. Financial risk. You're suddenly creating a new form of market risk with an ease of transfer, the creation of complex instruments, the increase of possible abuse from creators and operators of those platforms. At the same time, there's a counter argument to that. You're increasing transparency in terms of these transactions. You're increasing the capacity for the retention of control of an asset. So there are other issues: counterparty risk, settlement risk, under collateralization. Excessive leverage, creditworthiness. Some people say, well, yes, fine, but in some platforms there's an over-leverage. So it's not that there's a binary, this is all wrong and something needs to happen, but there are risks that need to be considered. Some people talk about flash loans and artificial liquidity for short periods of time as being negative. Some people see that as near risk-free, low cost for capital for legitimate use. Maybe it's arbitrage and other things, but it can also be employed in different kinds of attacks. So it would be wrong of us to ignore all of the potential risk completely and think that no authority in the world will ever consider it. My own view on this is you have one extreme, which is everything is regulated as a VASP, and another extreme, which is no regulatory authority in the globe will ever consider anything around this, and both of those are wrong. And I think there's this really wonderful, interesting sort of grey block in the middle, and that is where I think some of the focus needs to be. I've referred to legal compliance just because the compliance risk seems to be the number one sort of focus point in the world at the moment. There are authorities, and I'm working with some of them, that they have a really specific focus on bringing that activity within the scope of, let's just call it the AML universe. At the same time, I've got no interest in uploading a certified passport copy to Uniswap, and that's not going to work. It doesn't work in many different contexts. So the question is how to address some of those risks, and there are lots of challenges. The legal status of code, autonomous execution and immutability, combined with existing regulation, trust in a contract. There are governance-related mechanisms or changes to code, the mechanism for change and control, and the fiat points, the fiat entry and exit points, and this might be something that Sean can speak to as a bank looking to support the space, but the fiat rails on and onto the DeFi universe is another issue or focus point. So I've talked about what are the options, what's going to happen. there are lots of different ways that people can think of this. One is nothing's going to happen. Nothing will ever change. I think that's really unlikely. Other people say, well, you can't regulate this, but is it going to be an approach to risk disclosure? Buyer beware type approach, that there is incumbent risk and you're making people aware of that. Is it going to be the other extreme, which is regulation by enforcement or regulation by prohibition or restriction? Kind of doesn't really work either. And actually, we've seen this in China and other places. Sometimes outright bans simply just move things more into unregulated markets. Or is it a question of new standards, new approaches, new styles and kinds of licenses and frameworks? Is it sandboxes and limited license frameworks, or is it the application of principles of law to new technology in new and different ways? There are challenges. Who is a regulator going to regulate? Who's the counterpart? Who's covered? The AML point again. And I'm gonna go on to the AML point just because it is such I talked about conundrum, and here it's interesting because in reality, if you look at some of, and this is an example of one of the liquidity pool risk assessment exercises on one of the Uniswap liquidity pools, and it's wrong to just think that there's nothing incorrect that's happening. The reality is that when you look at the data of who's actually, so if there's a gigantic KuCoin hack, yes, it's true that there are many, many thousands of transactions that effectively try to use decentralized platforms as form of mixers and tumblers, and then there are Tornado Dash layers on top of that, and then payment gateways that are also unregulated, and they are being used. I mean, in this report, there were 7,971 material AML, CFT, and sanction breaches, and the risk indicators being picked up on those platforms related to all sorts, hacks, exploitation, fraud, sanction breaches, etc. So it's kind of wrong to think that nothing's going to change, but it's also wrong to think that it all has to be regulated like everything else. And there are interesting new systems. I think this is an example, one extreme. So not a KYC onboarding process for someone, but a risk assessment, a decentralized Oracle-based system for risk scoring the wallet, making an interaction with a platform. And in this example, it is a dangerous wallet. It's through a MetaMask transaction, etc. And it comes out as a completely restricted transaction. Would that satisfy the authorities? Is that enough? There are other, more clever systems with actually defining or whitelisting specific addresses which have gone through certain KYC processes, and there the proof of KYC is sort of broadcast to the blockchain or to a public blockchain without the actual KYC, the actual ID and data isn't. But that can be accessible to relevant authorities. Could that be one? Or decentralized identifiers, and again, there are many examples of this that are going on. Some people, by the way, on the flip side say, well, it's not really that risky. I mean, if you look at, this is also a direct report from the FATF, if you look at the proportion of identified illicit transactions on the Bitcoin protocol between 2016 and 2020, they're very low, and those are different analytics reports, but it's 3.3, it's 2%. Some people say, well, this isn't really an issue. There's much higher volumes in the typical SWIFT networks and banking networks that go beyond that. So that's the question. Lastly, and this is the interesting point, is this the bridge? Is it going to be a CeFi to DeFi bridge? Are we going to end up with regulated, centralized platforms taking use of underlying decentralized technology to provide platforms, and being the permissions for that activity being with the CeFi platform that's then gaining access to those underlying decentralized networks? So the advantage of disintermediation, the design for the participation through these sort of controls environment starts to emerge. Is it going to be permissioned layers that have decentralized networks that have access through CeFi platforms that are categorized separately? And we're already starting to see that occur through platforms like Aave and others with permission layers and exchanges as well. There's a lot of movement in that way. So taking advantage of the tech, but providing that layer of security as the entry and exit point. Lots of things are going to happen. I think that DeFi done right is going to substantially affect the financial system in many, many different ways. But that's not without its challenges. And one of the challenges, and I mentioned very briefly, is the fiat rails or the entry-exit points to those universes. And a critical part of that is the banking layer. So this is almost a sort of impossible hospital pass to Sean. But from that banking context, I think he's going to speak now a bit about the thought process and how that kind of universe can see this kind of application and development. Over to you, Sean.
First off, a huge thank you to Joey. I couldn't have done a better introduction. And it's a very good overview of Gibraltar regulation and how this interfaces with DeFi. In brief on Greengage, please allow me to introduce myself. Sean Kiernan, the CEO. We are setting up a bank in Gibraltar, which is crypto-friendly, purely B2B, so following in the footsteps in a way of Zappo, being retail-friendly. Our intention is to bank all of you, actually, if we can, and take the deposits from the crypto sector to give loans to Gibraltarian and UK SMEs, and eventually offer digital debt. We're delighted to be here in Gibraltar. It's a very forward-looking jurisdiction. Obviously, we've heard about the first legislation in the world in 2017 being crypto-specific, and seeing this conference here today with such wide attendance is testament to that. But DeFi is admittedly in its early stages, as is our engagement with it, and I would hope we would be one of the first banks to engage with it properly. To set the context, I'm also going to quote the SEC chairman. Minister Isolas mentioned him earlier today, but I'll take a slightly older quote from 2018. When he said, quote, "With increased competition and innovation in the financial system, DLT, both permissionless and permissioned, offers a catalyst for change by incumbents, or as an opportunity for entrepreneurial startups, potentially lowering costs, risks, and economic rents in the financial sector, which currently represents 7.5% of the US GDP. 7.5% for financial services is quite hefty. And when the SEC chairman mentions financial rents, I think those of us in the banking space would call that fat. As a startup, Greengage has no vested interests, doesn't have legacy systems, and we're watching DeFi as a really lens. Right now it's a bit of a Precambrian explosion of innovation, and we're trying to learn from what's happening and seeing how we can use this effectively as a decentralized balance sheet, an extension of our own. Banking is one of the oldest professions, there's a few others, and money is also, has its roots in the oldest civilizations. Essentially, and perhaps an oversimplification, banking has essentially two things that it contributes to an economy. One is liquidity, so offering the safe movement of money, and the second is the pricing of risk. And that effectively for a bank is what I call balance sheet activities or credit. So why is DeFi interesting to a banker? When financial services is so lucrative today, Greengage is a challenger bank, and I don't think we have any shtick necessarily, but we are very much hoping to bed in Gibraltar. And of the two key activities that we intend to offer, I mentioned liquidity and the pricing of risk, our focus is very much on the balance sheet activities. We've seen a lot of innovation, particularly in the payment space, and here I'll reference China with what's happening with, say, Alipay and WeChat, where basically that payment space costs nothing. And obviously there's concerns around potentially governance around access to financial services using private companies, and also data privacy with China. But we think that level of innovation represents things that can be brought to the West, and we think DeFi is actually a killer app, potentially, to bring those to higher level things. So I'm going to list 4 things in particular that are really attractive for us in DeFi. One, obviously, is reducing the frictional costs, not just in payments, but for higher order issues, like complicated products as derivatives and securities trading. I think second, and probably most attractive for me as a banker, are the returns. Double-digit returns are unheard of in the traditional space. The question is, are these sustainable once various factors have been priced in? And Joey's already spoken to some of those factors, and I'll touch on them later. Third is, can we engage with DeFi as a way to give our clients better deposit rates? If you look at high street banks today, it's basically abysmal rates, close to zero. And is there a way for us to effectively compete with high street banks by engaging with DeFi in some capacity? And third is, actually some financial services houses are already touching DeFi. We don't know how exactly they're accommodating this still, as it's unclear from the regulatory perimeter where DeFi sits. But the likes of Andreessen Horowitz are investing heavily, Goldman Sachs, and the broker group. And so we're also keen to see what the competition's up to. This all sounds great and very exciting. So I think for us, I just wanted to explore a bit what the challenges are and the direction of travel. Wharton at the University of Pennsylvania recently put out an excellent report, which really was just setting the stage of terminology around DeFi. This is a really important step because as regulators look at the space and as business, just having common definitions is really the first way that people can speak and form something a little bit more on top of that. Otherwise, however, there's very little material available in the public domain in terms of what higher level things, particularly as governing bodies get their heads around this, need to be addressed. And so what I thought to do is just speak through kind of some of the concerns that we're thinking through in our discussions within the team at Greengage and also in the market. And we very much intend to get involved in working groups as these get set up, and I'll speak to that later as well. The first issue of 7 that I'm going to discuss in terms of challenges, but also some mitigating issues, is one Joey mentioned already, which is identity. Obviously, KYC and AML is a big concern for banks. We wouldn't be able actually to engage today as yet. There are individuals in regulated firms, including the head compliance or MLRO, who would go to jail if we engage with illicit activities. And with DeFi, particularly with most platforms, you don't know where the other leg of the trade is coming from. This is fully decentralized, so it could be a rogue state, it could be a terrorist. As yet, that's a bit tricky for an MLRO to sign off on. So how can a bank like us engage? Obviously, staking and mining, the base layer, supporting the DeFi on top is something we can do, and other banks have done that. I've noticed Signum in Switzerland does offer a staking service. And if checks were to be included, for example, the walled garden approach, where a subset of firms fully KYC trades amongst themselves, or maybe, again, as Joey mentioned, whitelists or blacklists of firms. If that were to happen, how could a bank get involved? Eventually, it's something that I've been banging on for years. One of the big pieces of that 7.5% of costs is a growing industry known as compliance. And every bank and every financial institution spends the same money onboarding the same clients over and over. And this is all very important work to do, but in a way what DeFi could open up, if we do it properly, is a capacity for firms to share that cost and essentially reduce it for the end consumer. Meaning if we onboard collectively a client and they become known as a good egg, we could then trust each other. And I would hope in future that opens up, for example, the promise of open banking, where clients could effectively port their accounts between financial institutions at the drop of a button, if that makes sense, with a view that they could achieve the best service and best cost. The corollary to this opening up to KYC and AML is, will the returns remain of interest? Will the high rates in the double digits continue if it's more difficult to access? And we've seen some signs that perhaps there is a concern around that. Aave, which is one of the more institutional-friendly platforms, does have lower lending rates, obviously, than some others. But these are still considerably higher than high street rates. And so I think that's hopefully a sign of good for the future. The second issue that I'm going to raise is around the creation of money. And this is more from the perspective of a central bank rather than a commercial bank. In regards to the money supply and the setting of interest rates away from central banks. And central banks have been normally very much the guarantor of interest rates. Even with about 200 billion under management in DeFi locked in contracts, which is not an inconsiderable sum by any means, this is still really a rounding error when it comes to the trillions of assets that central banks look after. So I think as yet, there's still not too much attention being paid to this in terms of the impact that DeFi can have on the overall money supply. But this is definitely something that central banks are watching. I think there's a question around CBDCs and how these will be rolled out. It does seem, at least with some of the exercise, we're engaging with, for example, the Bank of England's consultation paper on CBDCs. It does seem that they're going to be looking towards having commercial banks be the guarantors of CBDCs if they can, and I don't know if that's necessarily the way it's going to be. But the likes of Avanti setting up in Wyoming are very much geared towards primarily being a home of a CBDC. And then there's the question around if DeFi can actually go around that all by doing virtual wrapped currencies. So I think this is still an area that we're, again, watching. The third issue is around making good. And we've seen that there can be hacks in DeFi. The code itself, while pure, isn't necessarily forever good. In traditional financial services, there's something called regulatory capital, that if someone does anything that they need to make good, there is money in the back pocket. With DeFi, and particularly with DAOs, or decentralized autonomous organizations, or even with the tech houses, if they are still set up as legal entities as opposed to no legal entity there, they don't have regulatory capital. And I think the concern around insurance, if there is a mitigating factor, is still to a large extent unproven. I've had to deal with claims and insurance in my past life, and often the fine print is the devil in the detail, and there's very few claims events to actually prove if this works. We hope it will, because I think it's a good sign if it does. The fourth issue is around governance, and here, with open source code and democratic principles, often it's quite a good thing. I've been fascinated speaking with a Bitcoin core developer recently who was explaining how that works in practice and how there's a community and everyone tests ideas and eventually consensus reaches. And that's fascinating from a centralized actor to see that actually taking place to good effect. However, I think there is also a question if setting certain basic regulatory standards and best practice would help to guide that code as it develops and make sure that it's good for consumer outcomes and for some of the issues I raised. I'm going to mention briefly Erica Stanford's excellent book, which came out recently, Crypto Wars, Fake Deaths, Missing Billions, and Industry Disruption, which highlighted the issues if individuals and very small sets of people control large sums of money. For example, the Quadriga case in Canada. Does having this code be open source protect against these issues? And to be frank, I don't know. And again, one that I would welcome thoughts afterwards throughout the course of the discussion. The fifth issue for us as a bank is always technology, ultimately. Financial services firms are largely technology houses these days. And so the question is, which is the winning code? Ethereum is setting the base layer for most DeFi protocols today, but not by any means exclusively. We're very delighted to have had IOV Labs invest in us, and they're building smart contracts on the Bitcoin blockchain. And as we build tech as a firm to engage with these systems, it's quite difficult to plan ahead for years. So we're trying to see where this lands. And there's also a question around interoperability. Will these various DeFi protocols building on top of various blockchains end up speaking with each other? And will the proof of work and proof of stake discussions end up changing that whole dynamic in turn? This is something that no one has a crystal ball, so to build tech around this, and as a banker, we're definitely agnostic and trying to be friends with everyone. So hopefully we can at least keep our eyes open. The sixth issue is around the user interface. And here, I think we see that as DeFi is built by technicians, the user interface is quite techy and not yet slick. Again, if we're looking to roll out across on a more broad capacity, this whole Napster moment, if you will, of really basic interface but doing good stuff, needs to somehow get a Spotify coming out there and building the user interface that allows people to actively engage. For us as a bank, we're always concerned about APIs and how do you speak with systems, and that language is quite important. Without having that effectively built up in a way that we can speak with someone, it's difficult to build. The last issue is really on if we can place our own balance sheet into DeFi, meaning as a bank, and this is very much from a banker's perspective, you have deposits and you've got loans. Can you put some of those loans into DeFi and earn those rates? And it's still early days to know exactly what risk-weighted assets would be applied to such protocols. We'd assume they'd be very conservative. But if we could even put a fraction of the balance sheet into DeFi and get the rates that we're looking at here, the blended rates overall for return for the net interest margin would be very attractive indeed. And so we're considering if that's possible and if we're going to go down that route. But again, we're not doing this just yet. I apologize for raising so many questions. I didn't mean to come up here and give answers. I don't think I could. But I think this is definitely a hot topic amongst our team at Greengage and with everybody I'm speaking with in financial services, that at least the crypto-friendly ones are watching this closely. We've been very keenly following this story, and I would very much hope to speak with you all. Joey and I are having a little chat if there's potential to work with a university to explore these topics further. I think that Wharton paper really just set the stage 1, but stages 2 and 3 are quite exciting. If there were to be a place in the world that probably could come up with finding a way to bring DeFi into the regulatory perimeter, it is a place like Gibraltar, which is why I'm, again, so excited to be here. And thank you, Pete, for having us. Thanks.